Ever heard of a group of investors who consistently crush the market for decades? Not through some secret algorithm or risky bets, but with a simple, powerful philosophy. Today, let's dive into the legendary article, The Superinvestors of Graham-and-Doddsville. This story, originally a speech by Warren Buffett in 1984, profiles investors who all came from the same intellectual background. They were students of Benjamin Graham and David Dodd at Columbia Business School. Think of it like this. If you gathered all the winners of a national coin-flipping contest, you might think it's just luck. But what if you found out they all came from the same small town and were taught by the same coin-flipping master? You'd probably want to know what that master was teaching, right? That's exactly Buffett's point. These investors, including Walter Schloss, Tom Knapp, and Buffett himself, weren't just lucky. They were all practicing what Graham taught: value investing. The core idea is brilliantly simple. First, see a stock not as a blinking ticker symbol, but as a piece of a real business. Understand the business before you buy its stock. Second, and this is the magic key, use the market's mood swings to your advantage. Graham introduced the concept of Mr. Market, your imaginary business partner who is a bit emotionally unstable. Some days he's euphoric and offers to buy your shares at ridiculously high prices. Other days he's panicking and offers to sell you his shares for pennies on the dollar. A smart investor doesn't get swept up in his moods. They ignore the hype and fear, and instead patiently wait for Mr. Market to offer a great business at a silly, low price. The third principle is the margin of safety. This means only buying a stock when its market price is significantly below your estimate of its intrinsic value. It's like buying a dollar for 50 cents. This buffer protects you if your calculations are a bit off, or if the business faces unexpected trouble. It's the bedrock of preserving capital. The superinvestors weren't a monolith. They had different styles. Some focused on tiny, obscure companies, others on large, well-known ones. But they all shared that core DNA. Buy businesses, not stocks. Use market folly. Don't follow it, and always demand a margin of safety. They're incredible. Long-term track records prove that this isn't just theory. It's a practical, repeatable framework for success. So, next time you see the market going wild, remember the super investors. They showed us that with discipline and the right mindset, you don't have to be a genius to do well. You just have to be sensible. Thanks for watching. If you found this interesting, hit that like button, follow, and subscribe for more deep dives into the world of investing. See you next time.